example, you can make profit $50,000. If you sell 800 units, no profit, break even. So you have a safety, a buffer zone. Okay? This buffer zone is 200 units. This is called margin of safety. Everybody know how to calculate margin of safety. I just try to tell you that if you miss your target, sales target 1,000 units, okay, how comfortable are you? 200 units, okay, you have to be careful. If you lose 201 units of sales of your target, then you're going to lose money. So this is called sensitivity analysis to see how sensitive. Sometimes it's very close, sometimes bigger. The bigger, you're more comfortable. We also talk about margin of safety. This is sales with the target income. TI, target income. This is sales, break even. This is called margin of safety. And last class, we say sales minus cost of goods sold is called gross margin. Gross margin percentage is calculated taking gross margin divided by sales. Number one. Number two, sales minus variable cost. You have sales, you have this cost, you have no sales, you have no this cost. So now this is called contribution margin. Contribution margin percentage equals contribution margin divided by sales. Number three, I told you learn one, you learn three. What is margin of safety percentage? Sales with target income minus sales break even equals margin of safety. Margin of safety percentage equals margin of safety divided by which one? Sales with target income, not sales break even. So in the past, some students get confused. Which number should I divide? Okay, you should divide sales with target income. Okay. So this is what we learned last week, and we said, how do I calculate sales? We start from this formula. We don't know sales, so I say I change the formula a little bit. Then I can figure out sales, because the whole chapter is trying to figure out the sales. What's the target sales? Then you can have this profit. Okay, so I move the number around. Equals contribution margin divided by contribution margin percentage. Okay, so we talked about this last class. Now, what we talk about is this. We say sales minus variable cost, give me contribution margin. Minus the fixed cost, give me EBT. Okay? So if I know my variable cost is a percentage of sales, because it varies with sales. So suppose this is 50% of sales, this is one sales. Your contribution margin is 50% of sales. Half and half. But fixed cost, you know it because how much you spend every month. Suppose fixed cost is 50,000. Okay? Now, the first thing is we establish break even. No profit at all. Zero profit. Which means that you calculate backwards, your contribution margin has to be the same as your fixed cost. Are we okay with this? So the contribution margin here can be substituted with the fixed cost. They have to be the same. This is break even. No profit. Just fixed cost. Now, if you want to have a profit, let's say you want profit $20,000. Then what happened? Your contribution margin has to be bigger, not only cover 50,000, also you need to have 20,000 left over. So you add the two together, your contribution margin has to be 70,000. Are we okay with this? Contribution margin bigger minus the fixed cost you have left over, 20,000. So contribution margin, in effect, is the two add together. So you add a profit. Okay? If you don't want to have a profit, it's called break even. If you want to have a profit, what kind of profit? Before tax? After tax? Okay, so I also show you how to convert from after tax to before tax. Hey, suppose the company pay 30% of tax. So this is 1, this is 0.3, so earning after tax is 0.7. So this one is 6,000, 14,000. Okay, so suppose you don't know this number. You don't know before tax income. E1x tax 30% of x, after tax 70% of x. So if 0.7x equals $14,000, x, you move this over, $20,000. So anytime if you have a number is after tax dollar, you want to convert to before tax, you just need to divide it by 1 minus the tax. Are we okay with that? Okay, so here, the profit, what you need is EBT, but EBT equals EAT divided by 1 minus the tax. The same. Okay, so this is what we did last class. Oh, sorry. This one. Okay, so now operating leverage. We talked about this last class, just a brief review, okay? Company depends on the industry you are in. Some company they have high fixed costs. It's out of your control. You have no choice. Big manufacturing business, you have big machinery, you have big rent for the factory. But then you have to find a way to work to your benefit. So last class I mentioned, intuitively, you don't want to have a high fixed cost because a high fixed cost is risky. What if you don't sell enough to cover your fixed cost? You're going to lose money. So high fixed cost, high risk, but high reward. Why is high reward? Because once we hit the break-even point, what's the break-even point? Break-even point means that we cover our variable costs, cover our fixed costs. No more fixed costs to cover. Additional unit of sales. We have additional unit of variable costs, but no fixed costs to cover. Okay, so I show you the company, service business, and manufacturing business. I showed you this last class. Didn't I show you this last class? Okay, so service business and manufacturing business, they all start with $1 million. But manufacturing business, the variable cost is smaller. Only material cost and labor cost, $250,000. So you have a big portion, 75% is contribution margin. Okay? Now fixed cost, very big, 60,000, 600,000. But if you look at service business, very high variable cost, labor, professional fees. The one hour they work, they charge $100 or $200, very high. Okay, so now you have 30% contribution margin, but additional unit of sales, you only have 30% left over to cover your fixed cost. Thank God, they have a lower fixed cost, only $150,000. So both end at 150,000. So I mentioned that degree of operating leverage, how we calculate DOL is taking contribution margin divided by earning before tax. Everybody knows how to calculate this. Just one number divided by another number. It's not difficult. But what does this mean? Okay, so contribution margin, based on this example, 750,000 for manufacturing. For service, it is 300,000, much smaller. EBT, 150,000 and 150,000. Degree of operating leverage, 5 times. This one is 2 times. We are looking at the ratio between the contribution margin and the profit. And why it's big? Because we subtract a big amount, so the EBT is smaller. A big amount divided by a smaller EBT, you're going to have a big DOL. Bigger DOL. That's why you subtract a smaller fixed cost. The ratio is not very big. So what does this mean? This means that sales go up a little bit. Let's say 10%. Okay? The profit, you times DOL times 5 times, your profit will increase by 50%. For the service business, sales increase by 10% times DOL times 2, profit will only go up by 20%. Doesn't go up as much. Okay? So what does this all mean? A little bit increase. 10% sales go up. How come the profit is not 10%? How come the profit is not 10% increase? Why is it 50%? The other one, why is 20%? How come it's not 10% increase? This is because a portion of it is fixed cost. Fixed cost doesn't grow. Okay? Only the variable costs grow. If you say 10% sales increase will be 10% profit, then everything is proportionally, everything is variable cost. Because certain portion of the cost structure is fixed cost. Fixed cost doesn't grow. So the more you sell, it's spread out, more units. Per unit, fixed cost is smaller. That's why you have more profit. Okay. So I'm going to give you another example, okay? So kind of more intuitive. We all travel, right? We all been to different countries and travel by air and so on and so forth. Okay, so airline industry is actually very high fixed cost business. They have to lease the aircraft, if they don't purchase it. Most of them, they just lease for 30 years or 40 years like that, okay? So then, to have customers come in, the traveler, you need to have a ground crew to check people in. What else? You lease the airplane, then also you need to have maintenance people in the airport. Huge high fixed cost, the fuel and everything, high fixed cost. So I'm just going to give you something simple so you can understand. So suppose an airplane takes 300 people to Asia, okay? An airplane takes 300 people. Suppose it takes 200 seats. They have to sell 200 seats on average. Let's say $3,000. Nowadays, to go to Asia is quite expensive, right? Just economic class, not premium economy, not business class, okay? About 300. Okay, let's just say on average, some are cheaper, some are more expensive. On average, $3,000 a ticket to go to Asia, okay? Now, we'll take 200 seats to break even. So what does it mean break even? The variable cost covered. The fixed cost also covered. Okay? Now, I'm the 201st passenger. I purchased the ticket. 201st passenger. Sales. I pay $3,000 sell additional ticket, they have an additional cost. The additional cost is variable cost. Can you tell me what's the variable cost for taking one additional person on the airplane, the same airplane, to go to Asia? What do you think? Yes?
Usually giving food on the plane.
Ah, yeah, food, right? Meals. How many meals? Asia, 15 hours to get there. Okay? They give you one hot meal, and they don't give you 3 hot meals, right? They give you maybe sandwich, snacks, and stuff. Okay? So how much do you think it's going to cost for one additional person? And also beverage, right? Drinks, beer, wine, juice, and all these kind of things. How much do you think? And snacks and stuff. How much do you think? Take additional person. You can guess. How much? And let's say if you are heavier, to lift you up to the air, okay? We need a bit more gasoline to push you up there. And also you have suitcases and stuff. How much do you think to take one additional person? The additional cost is going to be $300? $300 meals, not that much. Okay, $300. Okay, $300. Contribution margin for the 201st passenger. They make $2,700. Do they have to pay fixed cost by taking additional passenger after the break-even point? Do they have to pay fixed cost? No. So this is a big amount of money. Go directly into profit. So what happens is when you have high fixed cost, you want to sell as many as possible, so the fixed cost spread out more units. So this is what I will ask you in the midterm exam. Okay, you have to explain it. You say high fixed cost. Intuitively, it's high risk. What if you don't meet the sales target? You cannot even cover your fixed cost. But once you cover your fixed cost, you compare. You only have a smaller portion of variable cost to cover. So you're going to have a huge contribution margin left over. In comparison to the other company, you have a high variable cost. Even though you easily cover your fixed cost, after the break-even, you still have a huge portion. Each sale, you have a huge portion of variable cost. Okay? So here it says small change in sales or a large change in operating profit. That's what happens in airline industry. Small change, one additional person make you a lot of money. Okay? So this is what you're going to say. And you are going to explain, I asked you 2 points for 4 marks. Okay? You can say, after we hit the break-even point, additional unit of sales, you're going to have a smaller portion of variable cost to cover. So we have lots of contribution margin, but fixed costs are already covered. So the profit go up a lot. Another point is you say high fixed cost, high risk, high reward. And the fixed cost doesn't grow proportionally, so spread out more units, fixed cost per unit is smaller. That's why you're more profitable. Okay, so I want to finish that question. I don't know if I did that question with you or not. Because there's 2 groups, closer in speed and the other groups not. Okay, so we did this question. Okay, so margin of safety, sales with target income, contribution margin, target income. So I'm going back to the B, okay, quickly. It's a fixed cost plus the profit, EBT. Fixed cost is 220,000. It's given there. 100,000 plus 120,000, 220,000. Plus EBT, earning before tax, earning after tax, I want 140,000. 1 minus the tax. So this is 200,000. The profit, the 2 together is 420,000. Contribution contribution margin percentage or contribution margin per unit, $200, 20%. So we say it's 2,100 units or $2.1 million. Okay, to make $140,000. Okay, so the sales break even, we already figured out the first one. So sales with target income 2,100 units. You can use the units or dollar amount, both okay. Sales break even 1,100 units. So margin of safety is 1,000 units. As I mentioned, you have lots of room. It can be off your target, so you are relatively safe. Okay. So now, what's the degree of operating leverage? DOL is contribution margin at this level divided by EBT. Okay, so look, 420,000 is the both part. Fixed cost and EBT divided by EBT, the end. Okay, so this one is 420,000. EBT is 200,000. This is 2.1 times. So it's not very high in comparison, because this company, even though it's a manufacturing company, somehow their variable cost is very high. So only give you 20% profit, contribution margin. Okay, so the next part is, what if we want to increase the profit to 1.4 million instead of 140,000, $1.4 million? Then what happened? Okay, so sales at 2,100. I'm going to use units, okay? Because I can drop the 3 zeros because each unit is $1,000. Okay, profit $140,000. So now the question is saying, if I want profit $1.4 million, what's the sales has to be? Do I need 21,000 units? Yes or no? Profit go up times 10. How about sales? Go up by 10 times? Yes or no? Some people say no. Some people don't know, don't ask me. What do you think intuitively? Yes or no? No? Why not?
The degree of operating leverage is 2.1.
Okay, so what does it mean degree of operating leverage 2.1?
Like if you like make I don't know, 10% of sales, you get 21% of profit. So you don't. It's like a 1-to-1 ratio.
Exactly. So basically, in essence, it's because you have a fixed cost portion in there. That's why degree of operating leverage. You have fixed cost. If you need to go by 10 times and 10 times, it's everything proportional, variable cost. It's not, because part of it, it's a fixed cost. It's degree of operating leverage. That's what I tried to show you before. Okay, so now let's take a look at this. It's not. Okay, so let's calculate, okay? So sales with target income, contribution margin, fixed cost doesn't change, 220,000. But now your profit changed. $1.4 million divided by 1 minus the tax. This is $2 million. So the total is $2.22 million. Okay, so either 0.2 or $200. So it's 11,100 units or $11,100,000. So it's not 21,000 units. It's actually 11,100 units. You don't need proportionally. Okay, so I'm going to show you how this works. Why it's DOL, okay? So now let's take a look at the changes. So the sales changes, the profit changes. So you remember BO1, BO2, we are learning the changes from last year to this year, horizontal analysis, increase or decrease. Okay, so I'm going to look at the increase. So from 11,100 units minus the 2,100 units, this is the increase. Based on what? The base year, which is 2,100 units. Okay, so the number is 4.286 times. Now profit, $1.4 million minus 140,000. This is the increase. Starting from the base year is 140,000. This is 9 times. Okay? So remember earlier I was saying the increased sales by 10% times DOL times 2.1. It's exactly 9 times. So I don't have to go up because the profit go up by 9 times. My sales, I don't need to go up by 9 times. Only 4.286 times. Why? Because the fixed cost. Fixed cost is fixed, it doesn't change. Okay, so there are 2 points. You need to know how to answer it in the midterm exam. Okay? Alright, so now the last part of this chapter is something called multiple product in certain ratio. I was working on your midterm exam last night and I put a question there. So make sure you know this multiple product composite. It's the proportion. So last class I told you if you are in the furniture business or the window door business, when you sell a table, maybe you sell 6 chairs. So it's 1 table, 6 chairs. You may sell 1 table with 4 chairs. Depends. Okay, so this is with certain ratio, multiple product composite. Okay, so think about this. Just a few years ago when you were still in elementary school, right? You're not that old in elementary school. Have you ever been invited to birthday party, your friend's birthday party? Have you? No, some people don't want to say it because you never get invited to any birthday party. Okay, so you bring a gift to your friends for birthday party and you're looking forward. The end of the birthday party, you get a goodie back home, right? You're very excited. My daughter always looking for something. She always needs something. She doesn't need, she just wants those junk. Right? Okay, so what does the friend's mother prepare the goodie bag? Inside goodie bag, there are quite a few things. And every bag is the same. Okay, so this is what we talk about composite. If I'm in the goodie bag business, I always try to find out how many units of this, units of that, I need to break even. Okay, so for example, in the goodie bag, inside the goodie bags, let's say I have 2 bouncy balls. You know those bouncy balls? You hit? Okay, bouncy balls. 2. Alright, what else? You may have pencils. Okay, you may have a Pokemon pencil, or Hello Kitty pencil, or whatever the pencil popular item. Okay. So 3 pencils in there. Now, what else? Because they are little kids, we give them candies. They love candies. Okay, we give them 5 chocolate candies or whatever, or sour or something like that. Okay, so 5 candies. Now we have to figure out how many of each of these products we need to sell to break even. Okay, so suppose the sales for the bouncy balls is, let's say, $3. And each bouncy ball variable cost is $1.50. So the contribution margin per unit is $1.50. How many balls do we have in this bag? 2. Each one give you $1.50, $1.50. You have 2. So the 2 together is $3. So proportionally, you times 2 because I have 2. So $3. This is a contribution margin composite combined. I have 2. Okay, let's take a look at pens. Okay, so these are Pokemon pens, so Pikachu pens, whatever the pens. Each pen costs $2. Fancy Japanese pens. Okay, so sales $2. Variable cost $1. Contribution margin $1. How many pens we have? 3. So for this one, $1, $1, $1. So altogether, again, $3. Okay, how about candies? Let's say chocolate candy. Each one sells 80 cents, variable cost 20 cents, contribution margin is 60 cents. So each one give you 60 cents. How many we have? 5. So we have $3 contribution margin compensate. From the candy, I have $3. Are we okay with this? So you just figure out how much contribution margin from all these products, how much together. Okay? So now for this bag, all together, $3, $3, $3, all together is $9 for the composite. It's not for any particular item, 1 unit. It's everything in this goodie bag. Okay, so now I need to know what's my total fixed cost for the year. Suppose fixed cost for the year is $72,000. Fixed cost $72,000. I'm only selling these bags, for example. Okay, so how many of these bags? $9. I need to sell. The profit again $9 for each bag. How many I need to sell to break even? You divide it by $9. Contribution margin composite. So I need to sell 8,000 bags. But each bag I have 2 bouncy balls, so I need 16,000 bouncy balls. How many pencils? I have 3 pencils, so I need to sell 24,000 pencils. 5 candies, so I need to sell 4,000 candies to break even. Are we okay with this? Okay, so I'm going to show you how to calculate, and this will be in your midterm exam, okay? Alright, so I'm going to write it down nicely. So I have the balls, I have the pens, pencils, and I have candies. Okay, so the proportion is 2, 3, and 5. Sales. $3. Variable cost $1.50. So contribution margin $1.50. But I have 2 because this is proportion. I have 2 units of this times 2. So make $3. If you look at the pencils, pens, $2. Variable cost $1. So each pencil I make $1. How many pencils in the bag? 3 times 3. So also make $3. times the proportion, okay? Now candies, 80 cents. Variable cost, 20 cents. So contribution margin is 60 cents. How many 60 cents we make in this bag? 5 times 5. So again, $3. So total contribution margin composite, $9. But how about sales? Okay, no problem. Times 2, times 2, times 3, times 3, times 5, times 5. So this is $16, $7. So $9 profit per bag with all these products. Okay, so sales break even is 72,000 divided by 9, so it's 8,000 bags. You want to know how many balls, how many pencil, how many candies? So we take balls, 2, pencils, pens, 3, and candies, 5. We need 8,000 bags. So you need 16,000 malls to break even. 24,000 pens and 40,000 candies. This is number of units. You want to know the dollar amount to break even? You times the sales price. This is $3, $2, and 80 cents. $48,000, $32,000, this is $1. Okay, so this is exactly what I just show you right here. So we can use CVP, one single product. This is what I just did before we did this. Also can apply into multiple product with certain ratio. And how we calculate, it's the same, not difficult. We okay? All right, so now I'm going to talk about, now we're done with chapter 3, okay? Yes?
I have a question.
Yeah?
It's regarding like how do we determine fixed cost or variable cost? So I think it depends on the company cost structure, right? So for example, airline company just mentioned, maybe they have a budget for all the foods that they will source for food, and that itself will become a fixed cost to the company because they will estimate how many customers they will serve this year and source them higher hand. So they are not variable distributed in the facility, but like they source them out. So how do we determine it? And even machinery, there will be a capacity for their production, right? And at some point they need to buy another one to produce it. So
Yeah, that would be step cost, right? It's step cost because you have the fixed cost, the machine at this level. Then when you buy another machine, it's not, you can only produce 1 unit. You have to spend 50,000, but then you can produce. So that would be step cost. But in terms of food in general, it's based on number of people. They look at how many people going to fly on this flight. They're not going to put a lot more. Not because you have 300 seats, you have to put 300 meals in there.
I understand. It's like they have central kitchen.
Yeah.
They will estimate a year ahead, and then they will buy something like futures for food, so they can make it power hand. So all the budgets allocated by the beginning of the year for airline.
Yeah.
So that itself will to them will.
But usually the material for the food or this type of thing, we usually account for variable cost.
Sure. So just common sense.
Not because of fixed cost. It's not that every flight we have the same amount of cost for food, no. Right? Like a domestic, we don't have those costs. You have to buy. If you want to eat, you buy. But overseas, it depends on how many people. They can see. Not necessarily they're going to say, I'm going to subscribe to this many meals. It depends, right? Projection. Okay, now let's take a look at, yeah, exactly, use common sense. That's a good way to put it. Okay, so the next part, okay. Chapter 5, there are two components to it. The first component, we're going to use the concept of cost by function. Not mathematical equation, is what's the purpose of the cost? Is it manufacturing cost or operating expenses period cost? The next class when you come back, we're going to look at the cost from traceability. Can we trace or not trace? Okay, so this chapter, there are two parts to it. Cost flow. So what does it mean, cost flow? We are talking about manufacturing business. How much does it cost to make a product? So what does it cost? We have to have a material cost, we need to have a labor cost, we also have an overhead cost. All these costs we need to accumulate. Okay? So before we get into that cost flow, just think about in a manufacturing business, you buy material, stage number 1, you have a material warehouse for raw material, all the raw material in here. This is a production line. When you issue how many units we're going to produce, you're going to have somebody take the material out of the warehouse, put it in the production line. Okay? But what else going to production line? You cannot just put the material in there and say, machine, you make the product. No, you need to have people. It can be very, very automated environment. You still need to have people operate the machine. So labor is only in the production line. The labor is not in the warehouse. Okay? So the person who take the material into the production line, those are called indirect labor. But the person really operating, assemble the product together, those are direct labor. Okay, so the labor. But just put the material into the production line. The material cannot finish as a finished product. Can't. You need to have electricity, you need to have a machine to cut it, to sew it together. So you need to have an overhead in the production line. So in the production line, you have to accumulate how much overhead you're going to charge. A machine, $2 million, you cannot put $2 million in this month's production. You have to spread it out. How many years you're going to produce? That's why we call depreciation expense. So what going to production is material, labor, overhead. Now once you finish some of the product, you finish, where does it go? Another place, storage, finished goods area. You ready to, very soon you're going to ship, you're going to sell, you're going to ship it out. So when we are looking at a cost flow, there are 3 stages: material, production, finished goods. There are 3 stages in the cost flow, which means that if you have anything left over, you do not use all your material, you did not finish all of it, you have leftover material. It's called inventory, material inventory. When you make the production, you start production, okay? So we make the table. I put a top on, but then I need to put the 2 legs. But December 31st, late in the day, I only put part of the leg in there. 5 o'clock, finish, I'm going home celebrate New Year. I'm not going to continue working till I finish the table. What am I going to do with this table? When I come back January 2nd, I put more leg in there. Done. So by the time you leave, you have some product, you started, you put the material in there, you also put some hours of labor in there, you also use some machine, electricity to do part of it, not finished, left over. Those are inventory too. So this incomplete product inventory, we call it work in process or work in progress. Incomplete. They are inventory too. Okay, so we are looking at manufacturing business. You have an incomplete product, but what are you going to do with incomplete product? No problem. Next accounting period comes, January 2nd when you come back, you put more material, you put more labor, you put more overhead, you finish. So then you have finished goods. You sold some. If you do not sell all of your inventory, you have leftover, then leftover finished goods inventory. So the inventory means you did not sell, you did not get used up, left over. Whatever used up, cost of goods sold. You sold. Okay, so we're going to look at the type of inventory. For manufacturing business, we have 3 types. Not like BO1, BO2. We buy merchandise, retail store, you sell merchandise. Because you have a store, so you add value to it, you charge more. Manufacturing business is not, you have to make it yourself. So we have 3 different inventory left over if you do not use that. Calculation of cost of goods sold and cost of goods manufactured. Okay, so this is one new term for you. Cost of goods manufactured is the product you produce. How much it cost? Cost of goods sold. You're familiar with cost of goods sold. But what's the difference? Can they be the same? Are they different? They are 2 different names. One is called cost of goods manufactured, one is called cost of goods sold. So we're going to production. Earlier, I already talked about this. Material, labor, overhead. But the overhead only related to making the product. Okay? So are they the same or they are different? This is the second thing we're going to learn. And there are other cost terms we are going to learn today. Okay? Something called inventoriable cost and period cost. This is cost by function. What's the purpose of this? Is it product cost or period cost? Another term, you haven't heard about this, okay, so I'm going to talk about it. Something called prime cost and conversion cost. Number 4, most likely we don't have time to do it today, okay, so this is actually second part, chapter 5. So it's okay, I just want to finish the first 3 parts today. Okay, so what is the difference between cost of goods sold and cost of goods manufactured? Cost of goods produced, what's the difference? Okay, I'm going to tell you, okay? They can be the same, they may not be the same, okay? So cost of goods sold is how much you sold your product. Is cost of goods manufactured, produced, and sold, cost of goods sold. Are they the same or different? Same or different? It can be the same, can be different. Cost of goods manufactured means cost of goods produced. I'm just going to use the units, just easier, okay? Then we can always convert into dollar. So suppose I sell 100 units. Scenario number 1. I don't have anything left over from last accounting period. I don't want to have anything left over from this accounting period. I want to sell 100 units. I need to make how many units? I want to sell 100 units. How many units I have to make? I don't have anything left over from before. I don't want to have anything left over. I need 100 units. I want to sell 100 units. How many units I need to make? 100. This is not a trick question. They will be the same. Okay? If I don't have beginning inventory, I don't want to have a leftover inventory, ending inventory, they will be the same. Okay? Number 2. I show you. May not be the same. Okay? So I want to sell 100 units, but I have some leftover inventory from last accounting period. I have 20 leftover from before. That becomes my beginning inventory. I have 20 of them. I want to sell 100. Do you know how many you need to produce? How many do you have to produce? This is called cost of goods manufactured. How many do I need to produce? I already have 20. I want to sell 100. Do I need to make 100? Hello, hello? Are you listening? I want to sell 100 units, but I already have 20 units. Do I need to make 100 units? No, I need to make 80. Exactly. So they are not the same. Cost of goods manufactured, produced. I only need 80. They are not the same. This is cost of goods sold. Okay? So it all depends on beginning and ending inventory. Another scenario. If I want to have, I don't have beginning inventory. Okay, cost of goods manufactured, how many I have to produce? Suppose I want to sell 100 units, cost of goods sold. But I also want to have 10 left over, ending inventory. Because I don't want to run out of product to sell, okay? I want to sell 100, I want to have a 10 left over. I don't have anything to start with. How many do I need to make? 110. So 110 cost of goods manufactured and cost of goods sold, not the same. This one and this one not the same. So cost of goods manufactured and cost of goods sold can be the same if my beginning inventory and ending inventory is identical, either 0 or the same number. So for example, beginning is 10, okay, ending is 10, beginning is 10, then cost of goods manufactured, how many I need to make, and how many I'm going to sell, cost of goods sold, will be the same, 100 and 100. So this can be 0, 0, or whatever the number you have. As soon as beginning and ending identical, then your cost of goods manufactured, how many you have to make and how many you're selling, they will be the same. However, if the beginning and ending inventory not the same, then your cost of goods sold and cost of goods manufactured will be different. We okay? So that's what we calculate. Okay, so very quickly, we're going to take a look at the inventory type in manufacturing business. So there are 3 business types. One is service. So service we already know, we don't sell any product. So there's nothing left over. There's no inventory in balance sheet or you learn statement of financial position, nothing there. So in the income statement or statement of earning, there's no product cost, no cost of goods sold. But we have period cost. So it doesn't matter what kind of business, all have period cost, operating expenses. Now, merchandise business, retail store, they buy merchandise, they don't have to make anything, and they sell merchandise. So if you do not sell, anything left over, not sold, will become your inventory, leftover inventory. So in statement of financial position, in the asset side, we have merchandise inventory, leftover, not sold, from previous accounting period. Whatever you sold, okay, do not sell inventory. Sold, cost of goods sold. That's it. The 2 things. Whatever you sold become cost of goods sold. So we have cost of goods sold in the income statement. Manufacturing business, more complicated. You make the product. What going to make in a product? You have material. If material being used in the production, all used up, you don't have any left over. But if you have leftover, you have material left over in inventory. Okay? Now working process, incomplete product. Incomplete product is still product. Partially, you have the material, you also use electricity, you cannot see it. Also, people put it together, you cannot see the person in the incomplete product, but it's there. Okay, so you have working process, ending inventory. Finished goods, not sold, left over. You make it finished, but you're not sold. Okay, in terms of income statement, there are 2 stages. Number 1 is called cost of goods manufactured. How much it costs to make the product? And then cost of goods sold. As I mentioned to you, can be the same, may not be the same. Okay, and then we have operating expenses. Okay, now, I don't know if you still remember or not. I usually use this chart and look complicated. Okay, I'm going to explain to you. When I teach BO1, BO2, I always use the boxes, visual. If it helps you, great. If not, try to find a way to help you learn. If you find that I'm too fast in the class, please watch the video. I already recorded the video, okay, theory part. Watch it before you come to class, review it after, okay? Don't get overwhelmed. Oh, you're so fast. Well, I cannot go any slower because I have to explain it, I have to show you the question, 2 or 3 questions. I don't have that much time. Okay, so watch the video, try to catch up. All right, so complicated, but I prefer to use visual way to show you. Okay, so when I teach BO1, BO2, I hope you still remember the schedule cost per sold. I hope you still remember how to calculate cost of goods sold. Okay, I'm going to give you a very, very simple example, a story, a fake story, okay? But very simple and you will be able to understand. Okay, so suppose I have a side business, okay? I have an ice cream cart. And in the summer months, I will go to the park over the weekend. When it's very hot, I sell ice cream bars to little kids in the park. They're running around. You know those ice cream carts, right? They come, all the kids running to get ice cream. Okay, so suppose I have an ice cream cart. And I just sell simple ice cream cone. Okay? So I expect this weekend is going to be very, very hot. And I want to sell ice cream. But before I go to the park to sell ice cream, I look at how many I have left over from last weekend. And I look at it and I say, oh, I have 10 ice cream cones left over. Okay, suppose each one is $1. Okay, so that's $10 worth ice cream cone. Okay? Now, I said this weekend is going to be very hot. I need to buy more. Before I go to the park, I need to buy more. So I go to the wholesaler and I buy more. I buy 90 more. Do you know how many I have for sale? I have 10. I go up buy more, 90. Do you know how many I have altogether for sale? This is not a trick question. How many? 100. 100 means goods available for sale. I usually put goods available for sale. I call it gas. Everything available for sale. Because I have leftover, I buy more. Goods available for sale. Okay, so I only went out for four hours and I realized, oh, really, lots of kids running and buying and so on and so forth. I did not have time to keep track how many units I sold. Until 6 o'clock, I went home, I take a look. And I said, oh, I have 5 left over, not sold, left over. Do you know how many I sold? I have 5 left over. Do you know how many I sold? The missing part. You know? Altogether, I have 100. I only have 5 left over. Do you know how many I sold? 95. This is calculation of cost of goods sold. This is not a trick question. So in BO1, BO2, if you have to memorize step by step, it's very painful, right? If I explain this to you, not too difficult. Okay, so I'm going to plug in the terms. 10 that I have left over from last accounting period, this is called beginning inventory. Leftover, beginning inventory. 90 is additional purchase, P, stand for purchase. And in BO1, BO2, we have purchase return, purchase allowance, transportation, and all this kind of stuff. It's all in there. For cost accounting, we don't worry about it. Just purchase, 90. Okay? This should be the same, 100 here. Everything you have for sale, you either sold or not sold. Sold, cost of goods sold. Leftover, ending inventory. So this is ending inventory. This is sold. Okay, what's the sales? The difference between sales and cost of goods sold. And what's the same? The same is unit. The difference is the price. I sold 95, the unit 95. Each one, I sell $3, make a killing on a little kid, and $1 is my cost. So each one I make $2, 95. This is called gross margin. So in terms of unit, it's identical, but dollar amount is different. Okay? So this is called calculation of cost of goods sold. So we need beginning plus additional minus the ending. So the additional always add beginning and minus the ending. Always. Additional at the beginning minus the ending. So, I'm sorry, this is the only chapter in BO3 you need to know the debit and credit. Okay? If you're not familiar, you're not doing well, BO1, BO2, this you have to go back to review this. This is the only chapter we need to know debit and credit. Okay. I use a T account on top of these boxes. So one I give you the visual effect, the other one I use the T account to show you. Because these are inventory. Inventory. In accounting, we arbitrary, we put that aside. For us to record any increases, anytime when you want to add for the asset expense, as long as you want to add, we put it on the debit side. It's not whatever you want to choose. Anytime when you want to add, so purchase plus the beginning, you add them together on this side. On the credit side, right hand side for subtracting. Okay? Okay. So from the boxes, this side equal this side, but if I use the T account, normally what we will do is beginning plus purchase, additional, all these on the debit side, minus whatever we used up, the ending 5 is here, ending inventory. This is our T account. We always do it this way, whatever the balance. Okay, so the first one on top, you're familiar with, beginning plus purchase on this side equals whatever the sold and leftover inventory. Okay, so this chart is identical to stage number 3 and stage number 1. Okay, so merchandise purchases is like merchandise produced. Okay, so I'm going to show you, I have a chart here. Okay. Manufactured, produced. You can use it as P. B plus P. This is the P. Purchases. Okay? So finished goods, already finished, packaged, ready to be sold. Whatever leftover not sold, you add additional produced, not purchased, but you produce everything available for sale. This is goods available for sale. Goods available for sale, everything available for sale. Minus the sold. Sold, go out. You have leftover in the inventory. Okay, so this is finished goods. Now the first stage is raw material. How much material you have? Beginning inventory, you add additional purchase. This is all the material available for use in production. Not for sale, you're not buying for sale. You buy for use. So it's called direct material available for use. Sometimes direct material, indirect material may be put together. But some company may split the two. Okay? So this is the material, raw material. Now, if it's direct material used in the production, then it goes to here. Material used. If you don't use all of it, you have leftover, then you have an ending material left over. Okay, so now this is the first stage, and the third stage is the same. But the second stage is the most complicated, it's the most difficult. So I want you to pay attention. If you understand this, you go home very easy. Otherwise, go home, try to learn it difficult. Okay, so everything, we have a beginning, we have an ending. You already know that, beginning, ending. Okay. So what happens is in the production line, we're going to making a product, you need three things. I already said this many, many times since the first class. We have material used in the production, so this one come over here, production used. Second part is the labor. You hire people to work in the production line, so the second part. Okay? How many hours they work? How much we pay them per hour? We know the dollar amount. So each one is one item. But overhead, manufacturing overhead can be many, many items. Electricity, insurance, the rent for the factory, all these type of things, indirect labor, indirect material, a lot of stuff, property taxes, everything. I don't want to put it in here, too many items. So what am I going to do? I'm going to add them all together in the expense account. Okay, here. I'm going to put them in the expense account. So as long as the factory manufacturing overhead, the factory maintenance, everything, item by item, the end, the dollar amount, $1 amount of all the overhead, I combine them together, then I transfer, I put it over here, number 3. So number 3 can be many, many, many items. I group them not in the inventory, but in the expense account. Here. And the end, how do I transfer? Through closing entry, chapter 4, your bill 1. I close it by credit it and then debit into working process. Okay? You add the beginning, you minus the ending, you figure out cost of goods manufactured. I want you to write it down. Cost of goods manufactured. This is completed. Working process, incomplete. Cost of goods manufactured, completed. So completed product move out of the production line, going to the warehouse, ready to be sold. Incomplete product stay in the production line. Next accounting period you come, you add more material, you add more labor, you add more overhead, you complete it. Okay, so this is the cost flow. Now I want to do one question with you and make sure you know how to solve the problem, okay? Cost of goods manufactured and cost of goods sold. So this question, want us to figure out cost of goods manufactured and cost of goods sold. And you have this chart. It's better for us to use the visual effect first, then you can figure out the missing information. Okay? So the question wants us to figure out cost of goods manufactured, cost of goods sold, and income statement. This one we don't know. This one we don't know. That's why the question wants us to figure out these two numbers. Okay? So, how do I solve this problem? If I know cost of goods sold, I know the beginning, I know the ending, I can figure this one out, I can go back. But I don't know that, I don't know this, then I need to go from here all the way. So you have to know, for your midterm exam, you have to know either go forward or go backwards to figure out the missing information. Okay? Alright, so amortization. I'm going to ask you stages. Stage 1 is material. Stage 2 is production. Stage 3 is completed product. Okay? So now you tell me amortization for factory. What does this cost? Is it material? Hello, hello? Amortization, is this material? Is this finished goods? What is this? What is this? Factory amortization. What is this? Is it material? You say no. Is it labor? No. Is it overhead? Is it overhead? Yes. But what did I tell you about overhead? Can I put it right here? No. I have to put it in the expense account, overhead account. And then I accumulate all the overhead, then I transfer only one number. Are we okay with that? Okay, so this is the overhead, and I'm going to put it here. Okay, so this is amortization, factory, and this is 28,500. Are we okay? It's not material, it's not finished goods, it's in the production, but I cannot put it in the production because this is overhead. I'm going to add all the overhead together and then transfer one number at the end. Are we okay? Okay, now beginning direct material, stage 1, 2, 3. Which one? Where does it go? Beginning direct material. Stage 1, 2, or 3? Stage 1. Are we okay? Please speak up so I know you understand. Okay, so which box? Beginning. Okay, so 13,200. Are we okay so far? Okay, I try to figure out, okay? I try to figure out all the number. Now beginning finished goods. Stage 1, 2, or 3. Finished goods. Stage number 3. Are we okay? You have to be able to find it. Okay, so this one is 65,800. Okay? Do I have not complete product called work in progress? Work in process, beginning inventory, yes or no? Yes, and that's stage number 2. Okay, so now I put the number here, 24,800. So first I plug in all the number and I can solve the number, and after that I will show you the beautiful income statement, how to put everything together. Okay, now we just try to solve the numbers. Okay, so now we're done with that. Direct labor, where does the direct labor go? Stage 1, 2, or 3? 2. Labor can only in the production. Labor is not material. Labor is not finished goods. Labor in number 2. So this one is 88,200. Can you see it? I put it 88,200. Okay. Now, if I have the direct labor, I have an overhead, then I can figure it out, right? And of course, I need to have an ending even. Oh, direct material purchases. Direct material purchases, where does it go? Stage number 1. In additional material purchase, are we okay? Can you find it? Hello? Can you find it? I buy more material. Okay, stage number 1. So material purchase 98,200. Okay. Do you know all together how much material I have that I can use in the production? Can you figure out? I already start with 13,200. I buy more 98,200. What's all together here? All together, I have a lot I can use. It's 111,400. Are we okay with this? All together. So now if I know whatever left over, not used, then I can calculate the used part. Are we okay? You sure? Okay, so I just need the ending inventory. Do I have an ending inventory? Yes, 16,200. Beautiful. Would I be able to figure out how much material used in production? How much? Is it 95,200? Because both have to be the same. Are we okay? Alright, so now you have this number, it going to production line, 95,200. Okay? So far? Okay. So now the next thing is, if I have the ending of working process and I have the manufacturer overhead, well, I can figure out so now look. The boxes is not accurate, but I just kind of demonstrate to you. Okay. Whatever you produce, it's not the same as cost of goods sold. Actually, if you look at it, beginning and ending inventory, you start with more beginning inventory. You end up with less ending inventory, which means that you're going to sell more than what you produce and also take some of the beginning inventory. So you sell actually much, much more than what you produce, and you also take some from your beginning inventory. That's why your ending inventory is smaller. I may give you a question like this, so you have to know your cost of goods sold and manufacturing, which one is bigger, which one is smaller. Okay? You have to know that. Okay, so I have that number. Still, I cannot figure this one out because I need to have one of the missing number. Okay, what else do I have? Ending work in process inventory. Okay, 35,200. Okay, the only thing missing is overhead. Are we okay with this? You see this? The only thing missing is number 3. If I add all the number 3 together, I transfer here, voila, I can solve the problem. Okay, so now the next thing is factory insurance. Okay, so it's overhead. Are we okay? It's not material, it's not labor, it's not finished goods, it got to be overhead. Okay, so here is factory insurance, 8,400. Factory maintenance, 25,300. Are we okay with this? These are all overhead. It's not material, it's not labor. It got to be overhead. Okay, what else? Factory utilities, 14,500. How about general admin? Can I put it here? Yes or no? General admin, yes or no? Why not?
It's not manufacturing.
It's not manufacturing, it's the overhead, that's correct, but it's in the office. It's operating period cost, not manufacturing overhead. Okay, we'll skip that. How about indirect labor? Is it overhead? Yes? It's overhead, but it's manufacturing. Indirect material, indirect labor is all about factory. Okay, so indirect material, indirect labor. If you are working in the office, we don't call them labor. CEO, we don't call CEO labor, right? It's not their assembling product. Okay, so 19,500. Indirect material, so 7,800. Okay, sales. Can I put sales here? Sales is sales. Sales is not overhead. How about selling expenses? Selling expenses? No. Period cost. So 1, 2, 3, 4, 5, 6. 6 numbers. You add them all together. This is your total manufacturing overhead. Okay, so now I have number 3 component, beautiful. The rest is easy. 104,000. So I add them all together, what do? I transfer. So let me tell you this today, okay? These are the actual cost. I spent 8,400 for the insurance. I spent 25,300 for maintenance. This is the end of the accounting period. I know exactly how much I pay for everything. Amortization, I don't spend money, I don't pay money for amortization, but I already paid before. I just spread it out, the cost. So these are actual. The reason I want to mention this is next week when you come back, we're going to look at something, it's an estimate. When you finish this, you can figure out how much it really costs to make all these products. But sometimes this overhead, you won't know until the end of the accounting period, the end of the year. But during the accounting period, somebody asks you, can you make something for me? You cannot say, come back the end of the year. When I know my fixed costs, overhead costs, I'll tell you how much I'm going to charge. You cannot do that. So that's why business always have some working numbers for overhead. They use an estimate dollar amount based on previous years. And the end, of course, they are not going to be the same, so we do adjustment. So 104,000, then you have to use the estimate number to charge. That's what we're going to learn next class. Remember we talked about application number 4, point number 4. We're not going to worry about it. But today I want to mention this actual, because it's the end of the accounting period. You know how much you spend on all the overhead. Okay, so now I'm going to transfer, because I want to put this 104 in here. 104 here. But how do I do this? Okay, look. This is debit for increase, credit for decrease. Increase. This is expense. Also, expense debit for increase, credit for decrease. Increase more and more and more expenses. Okay, so how do I transfer this? I have to close this account. So it will be on chapter 4. When we close it, the end of the accounting period, we credit. When you credit this, somewhere has to go to debit. Debit and credit have to balance. So I put 104, 000 here. 1 you debit, 1 you credit. Okay? You debit here and you credit here. So this account cancel out, no more. Now you transfer this cost into product cost. Okay, so now for this accounting period, I spend 95,200 for the material to make the product. I spend 88,200 for the labor cost. I also spend 104,000 overhead. So for this accounting period, the manufacturing cost for this accounting period, the 3 costs together is 287,400. Are we okay with this? So this is what we call manufacturing cost, current period. This accounting period, I spend additional 287,400. I add on to the previous not completed product, 24,800. 24,800. So for the whole thing to account for, everything to account for, everything is 312,200. I have leftover not completed from before, 24,800. This accounting period, I spend additional 95,200 for material, 88,200 for labor, and 104 for overhead. I added 3 things together. This is the manufacturing cost incurred this accounting period. That is 287,400. You add the 2 together, everything to account for. Manufacturing cost to account for. 312,200. Okay, so can you figure out cost of goods manufactured? You spend that much money, but some of them not completed. So what's the completed? Will you be able to figure out? This minus this. You have the cost of goods manufactured is 277,000. Are we okay with this? This transfer over here, 277,000. Ah, beautiful. Can you figure out cost of goods sold? You start with completed product, ready to be sold, not sold, leftover 65,800. You make more. You make 27,700. You make more. All together, goods available for sale. All together, 42,800. Everything available for sale. You sold some, the leftover, you did not sell everything. So cost of goods sold, leftover, minus leftover, cost of goods sold is 290, 300. We okay with this? So it's done. Okay, so now I'm going to write it out nicely. Prepare schedule cost of goods manufactured, prime cost, conversion cost. I haven't talked about that. After I prepare the statement, I'll tell you. And cost of goods sold, income statement, step by step. Okay. Ready for this? Alright. So schedule cost of goods sold, cost of goods manufactured. Okay, so cost of goods manufactured is this accounting period. This one. The yellow one, this part. You can see that. Okay, so this part 277, how do I calculate? I need to figure out the current cost, manufacturing cost, at the beginning minus the ending. So the most complicated part is this part. This is the most difficult part. If you figure that out, you add the beginning minus the ending. You figure out cost of goods manufactured. That's what the question wants us to do. But then how do I know the manufacturing cost? You have three costs. Material you have to find from here. Labor, you plug it in. Overhead, you add them all together. Okay, so the first thing is I have to go back to this stage to figure out how much material used. Okay, so three costs. Number one, direct material used. Okay, so direct material used, how much I use? Okay, so beginning direct material, 13,200. We add direct material purchases, you buy more, 98,200. This is all the material you have available for use in the production. So direct material available for use. 111,400. Okay, so basically I'm just doing these two, 111,400. So this part is just showing you the visual effect. Wherever the missing number, then I'm showing you step by step. Okay, minus the ending. You always add the beginning minus the ending. Okay, less direct material. Or I said ending direct material. Ending direct material is 16,200. So this is direct material used in production, 95,200. This is element number one. Okay, number two is direct labor. You need to have three things to make the product. Direct material, direct labor. So direct labor, do we have the number? We already have the number to tell us straight. Okay, so direct labor is 88,200. Okay, so this is number two. Okay, number three. Number three is all the overhead. Now here, you have to write them all out. Manufacturing overhead, only manufacturing, period. We don't add, okay? So the first one is amortization factory. 28,500. There are six. Remember we did six before? Okay, now we skip to factory insurance. factory maintenance, 25,300. Are we okay? I just list all the overheads together. Manufacturing overhead. Okay. What else? Factory utilities. 14,500. Okay, I have two more. Indirect labor, indirect material. Indirect labor, 19,500. Indirect materials. So these are all going to making the product. 7,800. This is total manufacturing overhead. Okay, this is number 3 is 104,000. This is number 3. Are we okay here? We okay? So this is that box. 3 components. You add the 3 together. This is the current accounting manufacturing cost. You make the product. This is how much it costs you. Okay, you add the 3 together. This is called total manufacturing costs current period. This accounting period. You add the 3 together. This is 287,400. This is the current accounting period spent labor, material, overhead. Okay? So what do I do next? You add the beginning minus the ending. Add working process, beginning inventory. Working process, beginning inventory, 24,800. So this is a total manufacturing cost to account for. To account for, me to add them all together. Okay, so this one is 312,200. Okay, then minus working process ending. Because we did not finish all when we start production, something left over, so 24,800. No, ending. 24,800. Yeah, that's right. Ending, yeah. 35,000, I look at the wrong line. 35,200, thank you. Okay, so this is called cost of goods manufactured. How much it costs to finish making this product? So this is 277,000. Are you following? Are you okay? You following? What we're trying to do? Okay, so now you know cost of goods manufactured. You calculate cost of goods sold. As I say, if you don't have beginning inventory, ending inventory, or they are the same, will be the same as cost of goods sold. Okay, so next one is cost of goods sold. Okay, so cost of goods sold, we need beginning, ending inventory, beginning finished goods inventory. You add the additional production minus the ending finished goods. Okay, so finished goods beginning inventory. Finished goods beginning inventory is 65,800. We add additional production, cost of goods manufactured. Okay, so this one come in here. That's why one step at a time, one link to another. Okay. Okay, so 277000. This is called goods available for sale. Everything available for sale. So 342,800 less finished goods ending. These you did not sell. Leftover. 52,500. Okay? So this is called cost of goods sold. Cost of goods sold. So 290,300. You see, we only make 277, but we sell more. How come we make less but we sell more? Because part of sales is coming from previous leftover ending inventory, is our beginning inventory. Okay, so now we're done with this simple step, income statement. Income statement. Sales, 482,000. Cost of goods sold. You see, step by step, right? Step after step. 290,300. Okay, sales minus cost of goods sold is called gross margin. Leftover is 191,700. Now I have period cost. So this is the portion we talk about cost by function, product cost, period cost. Okay, so now we have operating expenses. So I have a general mean, 62,800, and I have selling expenses. That's 70,400. So total operating expenses 133,200. So operating income, this minus this, 58,500. Okay, what's this? Okay, so I want you to take a look at it, see if you know how to do it. I still have one item I did not cover, which is conversion cost and prime cost. Okay, so what's prime cost? Prime cost is the cost at its original being. It doesn't change. So material is material. Material cannot be a magician, suddenly it becomes a finished product. We like that, but it doesn't happen. So material is a material. Material does not change to finished product or half finished product. So those costs that at its original state it doesn't change, it's called prime cost. Conversion costs are the costs that will change from one state of being to another state of being. So for example, we need labor to make the, let's say you buy a piece of leather, okay, and this leather you're going to make it into a pair of shoes. So you need people to make it into shoes, okay? So that's called conversion cost. What else is conversion cost? The person cannot make a piece of leather become a pair of shoes. You need the tools, even if it's handmade. You still need tools. You still need a sewing machine to sew the sole and the leather together. So those are overhead. So now, prime cost are direct material and direct labor. Direct labor by itself, it doesn't change to anything. Okay, what's a conversion cost? Conversion cost, direct labor, and overhead. So you say, isn't this double counted? It's not double counted. quantitative. It's just what do you need the information for? You want to know the conversion cost or prime cost. Okay, so it's a very simple calculation. So I'm going to show you to add the two together. Who cannot do this? So I'll ask you this in the midterm exam, okay? So number one, number two, the two together, this is called prime cost. Prime cost is 183,400. Conversion cost, the two together is 192,200. 192,200. Conversion cost. Okay, so of course I'll ask you to calculate, but I will ask you more complicated than this. Not just, oh, what's the conversion cost, what's the prime cost? Everybody know how to do this. So I'm going to give you the variation. Okay, I'll ask you in midterm exam. Okay, so we already done this, just recap, okay? So manufacturing costs include direct material, direct labor, overhead. All these overhead we calculate on the side at the end of accounting period, one lump sum transfer to work in process. Okay, so in the balance sheet we have material, work in process, not finished product, and finished goods. In the income statement, we just did this. There are two steps. One is cost of goods manufactured, one is cost of goods sold. There are two steps. Okay, non-manufacturing costs, we have period costs, marketing, selling, and so on and so forth, general admin. Okay, so just show you the very last slide. So prime cost, as I mentioned, direct material, direct labor. Conversion cost is direct labor, manufacturing overhead cost. So in the balance sheet, manufacturing inventoriable cost is direct material, direct labor, overhead. Product cost, cost of goods sold. Income statement, now down the bottom, operating expenses, non-manufacturing cost, period cost. Okay, so now I'm going to tell you how I will ask you in the midterm exam. Please pay attention to this, okay? For example, I will say, I want you to know the relations among the three costs, okay? Because in next accounting class, you need to figure out the ratio, okay? So direct material, direct labor, manufacturing, overhead costs. These are the three costs to make the product. Suppose I say direct labor is 40% of the conversion cost, but also 60% of the prime cost. And I want you to figure out each cost, but I'll give you more information. Okay? So suppose I say direct labor is $40,000. Okay? Now I'm asking you, I just give you this information, okay? Direct labor represents 60% of prime cost, also represent 40% of the conversion cost. But I also tell you direct labor is $40,000. I want you to figure out direct material cost, overhead cost, and total cost. Will you be able to figure out? How do you figure out? 40,000 represent 40%. 100,000 is 100%. So conversion cost is $100,000. Are we okay? So overhead will be 60% of the conversion cost. So this is $60,000. Okay, but how about prime cost? How about prime cost? For 60% of prime cost is 40,000. So what is 100%? What's 100%? Prime cost. What do you calculate? 40,000 equals 60%. So how do you calculate? divided by 0.6. Okay, so 40,000 divided by 0.6 is 66,667. This is the total plant cost. A 40%, a 60% is $40,000. So 40% should be 26667. Are we okay with this? So what's the total cost? I will write this in the midterm exam, okay? Try to trick you. Put 66667 plus 100,000. I say total cost is 166667. Is that correct? Total cost. If you do that, you double counting the direct labor. So it's this one plus this one plus this one is 126667. You don't count the labor twice. Okay, so this is the type of question I will ask you in the midterm exam. Absorb this a little bit, okay? Take a picture of this if you need to. And have